Hey guys, Toby Mathis here with the Anderson Podcast. Today I have Benson Pang. Welcome, Benson, first off.
Thank you. It's such an honor to be on your show.
We love it. And Benson's we've known Benson for quite a while. He's not only he's not just an investor, he's also a business owner and has a good mortgage company there in Monrovia, California, right?
Yep, yep,
So he and I always want to call her your wife, but I know she's like your partner, Mimi.
yep. She's my partner in crime, my wife, my mom of two kids.
Yep. So she's a rock star too. So we've known these guys for a long time. If you've ever been to an executive retreat, you probably met them because they like to come out and hang out. But today we're going to focus in like a laser beam on the mortgage industry and what's going on there, what kind of products are out there for investors, what kind of products are out there for everybody, just people that are buying houses. And so I wanted to bring Benson on to say what's going on because there's so much stuff. Like our printing presses are running until their smoke's coming out of them because they're printing money so dang fast. And what is that going to do to our wonderful world of lending? So let's start there. What's
Yeah.
going on?
So what? How many packages has it been? So there's trillions and trillions of dollars pumping into the economy, right?
Yep.
So I think having that amount of money going into the economy, everyone's wallets got fattened. People are gushing into the market to buy a house. So if you don't already own a house, you probably are thinking about buying because you're feeling your rent increase,
Mm-hmm.
right? And then at the same time, all the homes are going up as well, and you're trying to get a piece of it. And the stimulus checks are coming in, so you just want you want a piece of it. So if I'm a renter, if I live at home, I probably want a piece of it. So and then last year in 2020, a lot of healthcare workers as well, they don't want to work at the hospital and then bring it back home. So they're also looking to buy a house to be away from their family, for their family's sake. And then on top of that, people who are in the last couple of years, people have a lot of children. So they're also looking to upgrade. So a lot of home buyers are coming into the market to buy with the new money coming in.
That's interesting. So you had healthcare workers who said, "Hey, you know what? I'm putting myself at risk," and they're either renting or buying another home. Is that what you were seeing? So that they could say, "Hey, I'm going to go to my safe place so I don't infect my family." Did you saw that?
Yeah, yeah, because a lot of the healthcare workers, they're given a certain amount of money from the hospital. Some places are giving out money so then they can rent a hotel nearby. So instead of renting a hotel, they'll use that money to go buy a house and use it for a mortgage payment instead.
That's interesting. And so in my neck of the woods, I'm in Vegas here in California. We saw a lot of issues with you couldn't even get financing on a house. Like you had to have come with cash. Were you seeing that as an issue in these situations when they're going out there bidding on these properties, or what was it? Was it pretty mellow there?
Oh gosh, we in California, we're looking at between 50 to even $300,000 above asking price. Right. In some
Oh,
rare
wow.
cases, we're seeing $1 million above asking price. Not sure if that's a listing agent kind of tactic, but you see a lot of demands going in. On top of that, appraisals are also having some small problems. We don't have enough appraisers to appraise all the homes that could be due to the pandemic. Um, but these homes are getting harder and harder to appraise because how are you going to justify $100,000 over asking price? So in California, it's hard to get into a property. So this is where the lender come in and say, hey, how fast can we close a escrow? Do we need all the contingencies? How can we make your offer as good as cash that you can compete with a cash offer?
You ever have people that just buy cash and then cash out immediately, do a refi to say, "Hey, I just want to get it, Benson, and I can you refi and get my money back?"
Absolutely, and that's really a talk with your loan officer, just because there are a few ways of doing this. One way is called the delay financing. So basically, you're buying the house and you're taking a cash out refinance afterwards. In some cases, they can put a lien on the house.
Hmm.
You can have a friend or like someone putting a lien on the house, so you're just refinancing that lien out of that house, but at the same time, you're still doing a cash offer.
Is that easier than doing it without a lien when you're just doing, hey, I just want to cash out refi versus,
They're both pretty easy. Obviously, if you have that kind of resources, that would be a wonderful thing to do.
yeah. And then are there any lenders that maybe specialize in, it sounds like a bridge loan almost like where they're coming in saying, hey, I'll give you the cash to buy it. But you got 60 days to refi it. Like, do you ever see that? Or are you seeing, hey, these people have to come in cash out of pocket, buy, and then do a traditional refi?
Yes, yes. There are places. I think there's there's actually a couple of fintech companies that do that, but at a cost.
Mm-hmm.
So you're bidding on top of what is already expensive house, right? So you might be buying it over the market value, and then you're also adding that borrowing cost on top of it. And now you go refinance, and your value isn't going to be there for you to take the cash back out.
What's the rate like? So you say expensive, but I know the Californians sell a house in California and come to Vegas and go, my God, everything's on sale, right? And then they bid it up like crazy, but they want to get cash out to live, but they might be sitting on, hey, I got $2 million from the sale of my property and I'm going to go put it down, but then I need to get that back out. Is there a difference on the rate they'll pay or what percentage if they do it that way versus just coming in and financing right at the beginning?
So there's a little trick I do, because when you do a delay financing, it's a cash out refi, right? And
Yeah.
cash out refi, and as you probably know, Fannie Mae is a risk-based company. Like they manage risk. So every risk, it costs money to the borrower.
Mhm.
In this case, cashing out money is a risk. So, so to mitigate that, like to answer your question, yes, when you do a cash out refi, it's more expensive than you just going out to buy a house as a purchase loan. In fact, now if you just simply refinance, there's a 0.5 cost that Fannie Mae added as an adverse marketing fee for all the refinances today.
Mhm.
So
So you get a little ding if you do it this way, but you'll get the house because you're not, again, if I'm a seller and I have two offers, one's for 1 million, one and the other's for 1 million, but one has financing contingency and the other one doesn't, I'm probably taking the cash, right?
yes, but there's a little trick around it. So if let's say if I were to go out and buy a house and I have $1 million in the bank, I would put a deed of trust, a short form deed of trust on that new house that I'm going to buy. Let's say
Mhm.
I want to finance 80%, so $800,000. So I'll
Mhm.
put a short form deed of trust. So after I close escrow, I'll go to the lender to get the loan, and now it's a rate and term refinance instead of
Will they
a.
let you do that even if it's your own deed, or could you do that with your own entity? Could you do that with a friend? What's
I
the deal?
would stick to. I'll try not to use myself as a trustee, right? I'll probably use a friend or a family member to do it.
That's pretty wild. What if somebody has like a retirement account? You have a buddy that's got a big fat retirement account. Could you go to them and say, hey,
Oh yeah,
got the cash, but I want you to lean this maybe for
just
a
make
line
sure.
of
You,
credit?
yeah, make sure you take care of him after.
Yeah. So it saves you a half a point, right? Or
It would save, yeah, three eighths of a point to have a point.
all right, so on
Absolutely.
$1 million property, that's a big chunk of money, right?
Yeah, $800,000 loan. That's $4,000.
Yep. All right. So and then when you're buying, are you seeing that it is what I'm perceiving here in Vegas? It might be different there, but are you seeing that coming in and requiring financing contingencies is costing people deals? Is that a reality or are you
It's a
guys?
real thing. It's a real thing. So I would advise all the home buyers, you know, get. I think instead of talking to a real estate agent first, you should probably talk to a loan officer,
Mm,
and really get that process going to get yourself pre-approved, get all the documents reviewed, so then you get a higher chance. Like let's say if your W-2 file, right, vanilla file, you you're probably going to be guaranteed to get that loan, that mortgage. Now you don't really need that financing contingency. And then if you're bidding over the house, you already know you're overpaying. You might not even need the appraisal contingency. With that mindset, obviously, you need to figure out what the worst case scenario, and that's where I come in and help you understand the risk of you removing any of the contingencies. So the least amount of contingency you can do to get into an escrow, the more higher of a chance you get into escrow. Uh, it's all risk, right?
Yeah,
Risk.
no, that makes sense. Shifting gears slightly is we're talking about residential loans for a house you might be moving into, but what if I'm looking at a property that I want to acquire, make it into a rental, duplex, triplex, fourplex, something like that? What are my options there? Are you finding that it's easy to loan on those too?
So if you already own your own primary home and you're looking to buy an investment,
Hmm.
that shouldn't be a problem, right? If you're trying to game the system, it might create a problem. So talk to a loan officer. Um, I recently a lot of these non alternative loan programs have come back online.
Hmm.
So one of the programs that we're offering, and it's pretty hot right now. It's called a DSCR loan, debt service coverage ratio. So as long as your income covers the the PITI, your monthly payment, then you should be able to get the loan. In some cases, you don't even need to cover the whole thing to get the loan.
So you're talking about it. So I'm looking at I already have my own house and I'm going to get a duplex. It's $500,000. And I say, I don't want to tie up all my cash in the duplex. So I can basically get financing for what's the typical thing, 70% loan to value, or is it
75% loan to value, so 25% down.
so,
Um, you get a pretty nice conventional loan.
okay, so I throw down, let's say it's 500,000. So I put down 125,000. The rest is being financed. Um, Typical rates, are they decent right now? Are they going to go up, down? What do you think?
They're great. They're in the low threes.
Wow.
They're in low threes, 30-year fix right now, 0 points.
Your balloon or anything like that?
No balloon, no prepayment penalty.
Mhm.
So obviously again, it's risk based. So if you're buying a single family versus a duplex versus a 3 to 4 unit, they all have different pricing. So that's absolutely a conversation there.
Do you know any PITI numbers off of again, a loan of maybe 400,000 off the top of your head? So you could figure out what the rents would look like.
So on a $500,000 house with 25% down, you're probably looking at about $2,300
Mhm.
in PITI.
And so would you need to have $2,300 a month coming in rent or net income to
So
qualify?
if you're qualifying for a conventional loan, we look at the global. So we look at your income, your credit, your assets, right? But
Mhm.
your income from your personal employment, and then on top of your other your investment properties, rental income, and you can also use the house that you're trying to buy, 75% of the gross rental. It's all added up to calculate that debt to income ratio. So if the ratio is right, then you'll be able to get a loan.
What's the typical ratio if you're just looking at the rents?
If you're just looking at the rents, so if you're looking at the rents, I mean, if I have a lower personal income to come in and
Mhm.
qualify, I probably want to at least have the house paying for itself.
Right.
Right.
But is that what they're going to look at, or are they going to look at you, your personal credit, everything, lump it all together and then figure it out? But I have lower income because I'm really good at doing some tax strategies, or because I have a bunch of real estate and I'm already depreciating the heck out of things and I'm a real estate professional, so it's knocking me down. If they look at just the income stream, is it just the gross income stream, or do they play around and say, hey, we'll allocate 70% of the of the gross rentals towards the payment, and we'll use that kind of factoring.
So in the conventional loan, we use 75% of the gross rental.
Oh,
But
nice.
earlier when I talked about the DSCR loan, we use 100% of the gross rental.
Wow. So wow. So, okay. So we know that's not really going to happen. So I'll just say this as a caveat. Don't do that if you don't have like this, your tax scenario may not be your cash scenario, right? I could still be showing $50,000 of income, but actually have access to 150, right? Because of the way real estate works. So make sure that it's not going to put you in a cash flow crunch. But wow, you could really loan, and that's not so bad. I mean, that's pretty crazy.
Yeah, so a lot of like, real estate investors, they might have a couple of years where they're trying to maneuver things and they're not showing positive income on their tax return. So they'll use this program, buy the house for a couple of years and then refinance into a conventional loan.
Fantastic. I mean, I've never been a big fan of debt, but I understand leveraging assets. So, and this is one of those great situations where you're leveraging an asset.
Yeah, I think a lot of times when people think about a 30-year fixed loan or 30-year amortization loan, it's not, in my opinion, it's not a 30-year thing. It's more so just temporarily cash flow issues. You gotta take care of things. You can pay it off whenever you want after, right?
Yeah, no, absolutely. It could be attacking it, but what it's doing is allowing you to leverage the cash that you have maybe into 2 or 3 properties that you're in a
Yeah.
comfortable situation to then attack the pay downs. How many properties can you actually do under conventional lending? So if I want to buy 5 or 6 duplexes, is that going to be a problem, or do I have a cap?
5 to 6, you're not gonna have a problem. If you're talking about 10 plus, then we'd probably have a problem. 10 plus finance properties.
Right. So you could have the backing Freddie Fannie on 10, and then once that's the magic number, and then you're not, now you need to go to the asset-based lender. We know those guys too. But
Yeah, I mean, in some cases, you can probably lump a couple of the properties into one loan. So you have a couple of low balance properties, you're trying to move it over to a property that has a higher equity.
Okay, interesting. So you might say, hey, that'll take away one of those loans, and this one has a little more room. So sometimes don't think of it as a loan per property. Think of it as a loan to the value of all your properties. Is that a,
Yeah.
do you help people with that?
Yeah, we'll go through their portfolio and then we'll provide some recommendations.
Yeah, I'm just going to put a caveat. That's why we talk to people that actually invest, guys, because typical mortgage broker, typical lender, they're trying to fit you in a box. Make sure that somebody understands what it is that your goal is. If I want to acquire 10 properties, 10 loans, maybe I should be looking at it as how much loan to how much value I should be, because I may be able to get there with 5 properties, right? And I don't have loans on the other 5, but I'm using the value, and that allows me to have more additional loans. If I want to do that again, I may be picking up 20 properties. Still, I only have 10 loans. Is that a fair way to assess it?
Yeah, exactly.
All right, so let's go back to all the crap that's going on right now. Again, the printing presses are going crazy. We're printing dollars. We have $6 trillion on the floor right now that may come through. What's going to happen to interest rates? And should people be refining now? Should they be looking at doing loans now? Should they be waiting? Look into your crystal ball and tell us. What do you think?
Hey, well, with all the money printing, and as we all know that when there's printing, there's inflation. We can all feel it, we can all see it, right, in front of our eyes. My Uber ride from the airport to my house the other day went up at least 20%. So the millennial inflation, that's yeah. Lumber cost is going up too, right? 2-3 times what it cost before. So all that inflation, what it really means to interest rate is the feds are going to be afraid of the inflation, so they might start raising the interest rate, which is what's going on today. Everyone's afraid of the Fed's increasing interest rate. So in the mortgage-backed security world, they're also trying to raise the interest rate to hedge against what may happen.
That's scary. They're afraid to even talk about it because they think it's going to tank the recovery, and we still have artificial inhibitors in the economy with this massive amount of federal unemployment that's being kicked out. I think that 24 states, 25 states now have opted out, maybe even more, because they realize it's not having the desired effect on their economy.
Yeah.
But you just have a lot of fear going on, so they're like scared to say that the nasty word of raising interest rates.
Yeah, so they're afraid of saying anything right now, because
Mhm.
not only you have to say what's going to happen today, you also have to say what's going to happen next week or next month, right?
Mhm.
The Feds last year had mentioned that they're going to keep the rates low until 2022. So
Mhm.
what's going to happen afterwards? But when it comes to refinancing, I think a lot of people have the misconception of that it costs money to refinance, that there's, whatever rate you see on the billboard is the rate for them.
Mhm.
But that's how they catch your attention. They're not there to tell you the interest rate. They're there to make your phone ring, make their phone ring. So I think this is where a mortgage broker will come in and help tailor a solution for the client, and give them the right choice, because it really depends on what your goal is, right? Everyone has a different goal. My goal is to live here for the next 15 years, but some people, their goal is to live there for five to 7 years, and then they're going to move on. So at that point, are you going to buy the points, or are you going to get some credit to help with the closing costs? So it's not just one interest rate. It's a spectrum of it, and which one's the right one, I think, is the conversation with your loan officer.
Fair enough. Fair enough. And whenever you're calculating, I don't mean to put you on the spot just because I tend to be mean, but again, debt's not my favorite thing. How hard should somebody be working to buy a house? Like, should they be chasing after a house? Should they be going 30% of their income with a mortgage payment? Do you ever look at that stuff and say, can you really afford this property? What type of things do you see? And what are the weird conversations you have with people?
Gosh, every single time, right? Every single time we do reality checks,
Hmm.
like we talk to a new first-time home buyer, and then we ask the question, what is your current rent? Is it 500, $800? And then you're going to buy a house that's $3,000 per month. You know, a lot of times I'll take their hand and say, hey, take a step back, and why don't you try to put away $3,000 a month first for the next 6 months, see how you feel. 'Cause the last thing I want to do is put you in a house, and then now you're going to say, hey Benson, how come you didn't tell me that I'm going to be house poor now? So it's a lifestyle change, right? It's a educated choice that you gotta have to make.
That's a really good way to put it, is you say, because it'd be the total value of the house. So I always tell people, it's like, look, there's property taxes, there's the insurance, there's the cost of repairs. You treat it just like a rental property. You're going to say, yeah, my capex, I'm putting 10% aside or whatever that value would be anyway. So it might be $1,000 a year. You're saying, hey, actually live that while you're renting, throw the extra money. So put $3,000 towards your living quarters or whatever the value, whatever you think it's going to be, to see whether you can handle it, so that you get into the house, you don't immediately have a flipping meltdown.
Yeah.
You can't afford a couch anymore, and you can't afford a bed, right?
Look, I've talked to buyers that make what, 15K a month, live at home, and
Mm-hmm.
have barely 10K in the bank. And you go, well, you got to start saving, because you're gonna have to make a big payment on the house. You
Mm-hmm.
you might not like it. Yeah,
So
Mike.
what you're saying is you're really popular in that first meeting when you're doing the reality check, when everybody else is saying, oh, you make this, oh, we can find you a house for that.
Yeah, no, I don't. My goal is to educate you as a buyer, right?
Mhm.
My goal is not just to make that dollar and move on. I've been doing it. I've been doing this for a while, and I've seen things that,
When it's wrong, and people are setting somebody up for an ulcer.
yeah,
Like
Yeah.
this is going to be a delayed bomb. You're going to have a heart attack in about 10 years trying to carry this thing.
Mhm.
Yeah.
And I've seen people who didn't listen, and they have to, after they buy a house, the house, and they put it back on the market in a year
Hmm.
just because they just couldn't afford it.
It's pressure.
Yeah.
Cooks them.
But it's pressure everywhere.
Hmm.
Social media, TV, television, and radio. We talk about interest rate, talk about mortgage all the time. Your
Yep.
family's like, hey, you're getting older, you need to go buy a house. But then the real question is, ask yourself, like, are you ready yet, right?
I love that. I never like, I'm a numbers guy, so I like to crunch them, but I never really thought about it. Hey, live it. So here's what your mortgage would be. Here's what the costs would all be. Let's lump it all up. All right, spend that, put that aside. You could take your rent out of it because we want it to be equal, right?
Yeah.
But see how that feels and do that. What would you do? 6 months, 3 months, 10 months,
I
whatever.
do 6 months just to see how you feel. And guess what? Your bank account is gonna get fat too during
Yeah.
that time you're saving that money.
Or you're going to be like, I can't afford it,
Yeah. Yeah, you're gonna
which
have
is,
that.
which is fine. Have the reality check. Like you said, you're better off not doing something and realizing that, thank God I didn't, than doing it and going, oh, I wish I hadn't, right? It's really tough to get out of a house, 8%, 10% to dump it. Right. So, um, really brutal, but I love that. I'm going to steal that totally.
And then they always forget about the upgrades, and you're trying to always, once you own a house, you just keep wanting to do things to it. Build out the backyard, buy plants, this and that, and you have perfectly fine lights, but you want LEDs. So there's always things that you can do to the house once it's yours.
I remember my first blinds. It was $11,000 to put blinds in the house. And some of you guys are like, oh, it's not that much. That was my first time I bought a big, like, I don't even have the size of a house now, but I bought it. I thought I was the bee's knees. And I just remember going, man, that's a lot of money. $11,000 for blinds.
Yeah, dude,
Woo.
curtains. You know how
And they
many
were the cheap
curtains you
ones,
have in
right?
the house, and you have to
Yep.
wash them.
Yep. You got to do weird stuff. Like, yeah, then you're going to have to get the lawnmower. I live in Vegas where we all have rock yards. So you just, water is expensive and anything electric here is expensive. So
Mhm.
it's just, you got to figure those things out. Do you ever sit down and get that granular with people and say, like, here's what your utilities are going to be looking like? Here's what this stuff is. Do you ever like sit there and flick them
Yeah,
in the forehead? Like, hey, you're going from an apartment to a house.
yeah,
Your electric bill is going to go from $50 to 200.
yeah. We go deep, and actually in a lot of occasions, I point them to your workshop. Yeah, yeah. I tell them to go take a course on self finance and learn about it yourself. You can hire financial advisors later. You can hire whatever planners later, but you got to learn how to do it yourself first. At least you know that someone's gonna screw you over.
Yeah, and you know what to look for when they say, come right on
Exactly.
in here. Look here, we can have this all set up for it. Yeah. Thank God that there's people like you, Benson and Mimi, that you guys are actually doing that, because I see the repercussions so often when somebody's trying to get out of their position. Like I lived here. I don't know if you were doing business during the recession, but in Las Vegas, we lost 75% of our values, and you watch people's lives literally crumble. And their last words, famous last words, but I have equity. They'd always say, but I have equity in my house. Nobody wants your house. Like,
Hmm.
you financed it at $1 million, right? And now it's worth 200.
Yeah.
That never happens. No, it happens. And it happened here. And the average was 75% reduction in value. Now it's recovered. So the old adage is, you're only 10 years away from, from fixing any mistake. Is you got to just sit on your hands and you'll be okay. But it's really hard when you're carrying a huge debt load. So we saw it. It was just so heartbreaking to watch people's lives literally get decimated because they bought something they couldn't afford.
Yeah, I think right now today with our system, I think that fixed a lot of issues that we had back in 04, 05. because people are actually really getting underwritten.
Mhm.
Their income, even if let's say if you buy $1 million house, you put $900,000 down, you're still going to go through the whole process. You don't get any priority. You don't get the 60% debt to income ratio. You're still 45%, just like everyone else, debt to income ratio. You still have to provide pay stubs and W-2s and tax
You're
returns.
like, but it's only 100. It's only
It's
100.
only, yeah, I hear that a lot. Well,
Mhm.
go make that 100 so you don't have to borrow any money.
Yeah, that's
Another
funny.
thing is, I see a lot of people that I helped back in 2012, 13.
Mhm.
Now that they're 5, 6, 7, 8 years in, I feel like because their income had gone up, they started putting more money into the principal on their 3.25% interest rate that's fixed for 30 years. So I think that's something that, when I see that, I cringe. I go, you need to figure out what to do with that extra dollar that you're making. Go
So you
talk to
see
some.
them just paying it down, and you would tell them, hey, don't necessarily pay it down. You got a 3.25 interest rate. It's not horrific. That's about inflation. Actually, it's probably less than inflation right now, right? So
Mhm.
it's like you'd be better off trying to get a greater return on those dollars.
Yeah.
That's
Yeah.
fair. That's fair. I mean, again, I'm not a big fan of debt, so I'm always like, hey, people ask me this all the time. Should I pay off my house? Well, it depends.
Depends. Yeah.
Yeah, if you have better use for the dollars and you can make 7-8% pretty without breaking a sweat, which you can do right now with dividend producing stocks and things like that, then I would say probably do that instead.
Mhm.
And it's not a bad idea, like in California, especially, is to have debt against your house because it's not protected under the homestead. So, so if you own your house outright, you might be asking for a problem unless you can do a friendly lien or put a line of credit against it with your own entity. But there's all that stuff, but it's just making sure that you're not a sitting duck. But heck, if somebody's willing to give me 2% money and I know that I'm without breaking a sweat, am I going to bring in 6? I'm doing that.
Yeah, yeah, absolutely. I think that's a point, right? Like, these people, they work so hard for their money, and they want to tuck it away as soon as possible into the house, that unless you refinance again, you can't touch that money again, right? Unless you sell it or refi, you can't touch the money. So what I would tell them is to put it in a bank or something, and then the next question is, well, I don't know what to do with the money.
Mhm.
And I tell them that's because you don't have it yet. Once you start saving enough,
And you'll
once
know
you
what to
learn how to save some, go
do. Mhm.
talk to my friend Toby, and he'll give you a whole list of things that you can do.
I appreciate that. Yeah, no, that's absolutely true. Is you got to buy assets that are paying you. A lot of people just go on more vacations or maybe buy more expensive furniture. Don't do that.
They buy happiness.
Get it to where it's producing the income off of it, and then take the income if you feel like it and buy those things. But definitely put it in the asset first. Well, Benson, thanks for joining us. Enlightening as always. Love sitting and talking with you, and I'm just really appreciative of you spend the time with us today. Any closing thoughts? Any pearls of wisdom that you want to throw at anybody before we conclude?
Wow. I would say I would say that the market's going cuckoo. And if you're looking to buy a house that's over the market price, you got to check out what is the break even point. Inflation, appreciation of your house, right? It's going to go up X amount of percent depending on your location. So talk to someone who knows their stuff, so you're not overbidding. There's a break even point. So I think talk to a professional.
Great one. Calculate everything. And then in the immortal words of Warren Buffett, he's still with us, so I should say that. Really good words of Warren Buffett is, when other people are greedy, be fearful. When other people are fearful, be greedy. So
Yeah,
if you see a lot of greed, go at it with a little bit of trepidation and then calculate the heck out of everything.
calculate.
Benson, you're a rock star. Thanks, brother.
Thank you.